Okay, the Dangote Refinery IPO is all over the financial news, right? But the way everyone's talking about it, they are completely missing the real story. We're here to break down the systemic shockwave this is about to send rippling through the entire Nigerian economy. You see the mainstream media treating this $20 billion Dangote IPO like it's just another stock listing. It is not. It is a massive liquidity vacuum that is going to drain the Nigerian economy this summer. This isn't just another company going public. This is the starting gun for a historic wealth transfer. So to really understand the impact here, we need to get past the headlines and look at what makes this IPO so fundamentally different from anything we've seen before. Think about it like this. A standard IPO, it raises capital for one company. That's it. The Dangote listing? This is a macroeconomic event. We're talking about something so large, its scale is going to push the absolute limits of the entire domestic capital market. And the scale, that's the first major red flag. We're looking at a 10% stake valued at around $20 billion. This isn't just big, it's the largest offering in the continent's history. The amount of capital required just to absorb this thing is, well, it's completely unprecedented. Now, buried inside this IPO is a hidden mechanism, a feature specifically designed to make it absolutely irresistible to investors. It's basically a sanctioned loophole to get your hands on US dollars, and it's guaranteed to create a feeding frenzy for these shares. The value proposition is as simple as it is powerful. You subscribe in Naira, but you have the option to get your dividend payouts directly in US dollars. In an economy that's seen its share of currency headaches, this is an absolute game changer. And the mechanism itself is a straightforward three-step process. 1, investors use their Naira to buy in. 2, the refinery, which is essentially a massive export engine, earns hard currency, US dollars. 3, that hard currency can then be channeled directly to you as a shareholder. It's a foreign exchange hedge built right into the fabric of the stock. And let's be clear, this isn't just some gimmick. It is backed by a projected $6.4 billion in annual export revenue. This incredible, stable flow of hard currency is what makes the dollar payout not just a promise, but a credible reality. Okay, so you have this massive, almost insatiable demand for capital, and it is on a direct collision course with a financial system that is being deliberately starved of cash by the central bank. This is where the real crisis starts. To get this, you have to understand the cash reserve ratio, or CRR. It's the slice of a bank's deposits that it's forced to park at the central bank. That cash is taken out of circulation. It can't be lent, it can't be invested, it's effectively sterilized money. Right now, the CRR for Nigerian banks sits at a staggering 45%. That is one of the most restrictive, highest ratios in the entire world. The central bank is actively and aggressively choking liquidity out of the system. And the effect? It's staggering. As of January, Nigerian banks had 52.6 trillion naira just sitting idle at the central bank. That's a 460% jump from the year before. This isn't a healthy system. This is a system where banks are so constrained, so risk-averse, they'd rather park their cash for nothing than lend it into the real economy.
So here it is, the collision. A $20 billion asset that every single major institution and fund manager is going to feel they have to own is about to hit a system with virtually no free cash. So how are they going to buy it? They're going to have to sell other things, aggressively. Real estate, other stocks, everything will be on the table.
Now, for the investor who sees this coming, this dislocation isn't a threat. It's a once-in-a-generation opportunity. The strategy is clear. You need to start building your dry powder right now. The market environment today is practically screaming what to do. Inflation is running at 15.1%, okay? But even a relatively conservative instrument like the Trust Band Fixed Income Fund is yielding over 38%. The real returns available to you just for staying liquid right now are enormous. And look, this isn't some one-off fluke. The data from early 2026 shows top mutual funds delivering real after-inflation returns of over 100%. Smart money isn't just sitting on the sidelines getting eaten alive by inflation. No, it's actively growing its cash reserves, its war chest, in these liquid high-yield funds. So the dry powder strategy is both simple and incredibly powerful. You park your capital in these high-yield, liquid funds today. You generate massive, inflation-crushing returns while you wait. And you maintain total liquidity. When that IPO finally hits and the institutions start their fire sale, you will be ready to step in and buy quality assets at a deep, deep discount. It's really vital to understand the stakes here. This isn't just another market event. It's a structural realignment that is going to create a very clear, very sharp divide between investors. Ultimately, this isn't really about buying a piece of a refinery. It's about understanding a much more powerful force, capital velocity. It's about recognizing when a massive amount of capital is about to be forced into motion and positioning yourself to benefit from the chaos that follows. So here's the final warning, and let's be crystal clear about it. The dividing line this summer will be liquidity. If your capital is locked up in things you can't sell quickly, real estate, private equity, whatever it is, you will be a spectator to a historic wealth transfer. You will just have to watch as others buy the very assets you wish you could. So we'll just leave you with this question. When the forced selling begins, when the prices on quality assets start to drop, will you have the dry powder ready to be a buyer? Or will you be a spectator? The choice isn't going to be made then. It's being made right now.